Intentionally, don't say purposely lah. I already tell you, I've forgotten already, ma. Okay? You always say what? Don't say purposely, like that. Not very nice. You say, Miss, is it intentionally forgotten or unintentionally forgotten? Deliberately. No, we're not so bad one. Okay? Okay. Recording. Okay. Record. Record your. Okay, today we are going to continue with the MFRS 119. That is with respect to our long-term benefits. Okay, long-term benefits, post-employment benefits, the long-term portion. Last week we have already covered the short-term portion, so this week we are going to do the post-employment benefits. And post-employment benefits is going to appear in your final examination. All right, so you can put 5-star by yourself. Okay, so important one, record. Okay, not important one, no need to record. So MFRS 119, was there any homework that I asked you to do with respect to MFRS 119 last week? Got or don't have? Yeah, are you sure that there is no homework that I asked you to do? Huh? Very good. The rest of you don't know one, don't do. Okay? Your friend here knows what was the homework all about. What was the homework all about? Ask your friend there. You can sell your information. $5, $5, $5, $5. Okay? You ask them to give you $5 and then you give them the info. Okay? I already mentioned that last week. I asked you to do two things. Alright? One is with respect to MFRS 2, another is with respect to MFRS 119. Two things only. I very rarely ask you to do things. Correct or not? And if I ask you to do things, that means they are very important. Okay? So MFRS 119, today we are going to look at the post-employment benefits. So which means that those benefits that the employees will receive after they have retired or no longer need to provide services. Okay? So this is what we have done. Basically, generally looking at how the employee benefit works. So of course you have two parties. You have one that is employee, that means the staff, and then the other portion is the employer. And I did mention that in line with MFRS 119, we are only looking at the employer's perspective, looking from the viewpoint of the employers. We are not looking at the viewpoint of the employees' folks. Okay, employers' folks. So if the employer has employees, they have staff, anything that they need to pay to the staff will be part of the staff cost. Okay, so that is why you will see that employer, when they pay amounts to the employees, which means that the employees will receive the benefits. The benefits could be in the form of short-term salaries. Okay, if post-employment, later we shall see. Maybe they will be entitled to pensions. Maybe they will be entitled to EPF. Okay, after they retires. Then at the same time, what the employee should do. Okay, so let's say you're only 26 years old when you graduate, then you work. Every time you provide services, then you expect that the employer will pay you. Okay, this is normal. So you provide the services, you get work done for the employer, and then the employer at the end of each month, they will pay you at least the salaries first. Okay, so this is a matching concept. So in other words, what do? We are trying to match the expenses to the revenue. So expenses incurred in order to gain the revenue. So we must match these two. Of course, in our books, we are also going to adopt the matching principle when we record the transactions in the books. So these are some of the categories of the employee benefits. The first one we have already seen in the last class, okay? Short-term employee benefits, monetary and non-monetary. So for short-term employee benefits, it will be very similar to the defined contribution plan that we are going to look at later, okay? But it's just that you don't have any accrual, don't have any actuarial assumptions, okay? Today, what we are going to look at is the post-employment benefits. So the post-employment benefits that we are going to look at, we have two. One is the defined contribution plan. The second one is a defined benefit plan. Okay, then we will look at other long-term benefits, like for example, some of the, let's say like in the context of universities, they may actually provide or let the employees go on sabbatical leave. So if they go on sabbatical leave, they probably go to some place, overseas probably as a research attachment. And when they go there, the salaries will still be paid. Okay, the normal salaries in Malaysia will still be paid. And maybe you get some grant to work on some research overseas. That one, the grant will pay your expenses. Okay, so this is what happens for the other long-term benefits. Sometimes it could be like on, let's say, 10th year anniversary. Okay, that is the long-term benefits. 20 years anniversary, 30 years anniversary, they will also pay you some kind of benefits. Okay, termination benefits. This is when the employer asks you to leave, not because the employee wants to leave, but because of certain things, the employer wants you to leave. So the employer will have to pay you certain termination benefits so that you're compensated while looking for the next job. Okay? So post-employment benefits. So post-employment means what? After you no longer need to provide services. So after the completion of employment, such as the following: retirement benefits. So you may have pensions. So how is pension money paid to the retirees? Every month you have to go and withdraw the money, all right? If I'm not mistaken, it's through the BSN, because every month end, don't go to Bank Simpanan Nasional, BSN. Long queue of retirees, okay? Lump sum payments on retirement, okay? Other post-employment benefits, such as life insurance, post-employment medical care. Which do you think is more important? Post-employment life insurance or post-employment medical care? Which one is more important? I think medical care more important. Life insurance, you die already lah, so what? You say goodbye, then who benefits? Your beneficiary. All right? But medical care, I think, is quite important. Okay? I think one of the very good thing is that if you're a civil servant, until the day you say goodbye, you will be given medical care free of charge. Okay? Depending on your level, so they have this retirees card. You go to take the LRT, MRT, you show them, they also give you a discount. That means the old man's discount lah. Okay? And then if you go to hospital, if you are a retiree with the card, they also give you free medical care. Okay? But for the private sector, usually I think you need to buy your own life insurance. Okay? But life insurance also is a dilemma. If I buy it very old, the premium is very high. So probably per month I have to pay 10,000. No lah, not per month. Maybe per month I have to pay per year I have to pay 15,000. If next year I don't die, I have to pay 15. The next year I don't die again, pay 15. I think I will die paying the premium. So that's the dilemma. I think if you're too old already, you didn't have any life insurance, never mind lah. Okay? People tell me that GH is very good also. I want to go and register when I reach 60. They say you cannot just go to GH1, you know, you got to go to the clinic kesihatan, KK first, in your region. Get the KK there, then only go register to GH. Otherwise, you can only go to GH if you go in there on emergency. Last year, last 2 years, last year I got vertigo, you know, last year or last 2 years, I can't remember. I went to the hospital in ambulance, all the way there. But vertigo, you know what is vertigo or not? Pusing. I open my eyes only, the whole thing all swimming. I can't even get up. I get up, I want to vomit. Every time I get up, I vomit. I can't even control. You get what I mean now? That was the first time I got vertigo. Too stressed already, the doctor said. All right? Then, because I'm so big, my husband also cannot carry me and put in the car. So he has to call the ambulance. And then the ambulance also come with 2 persons to carry me. Also very difficult because too berat already. Because, you know, when you are almost out already, you really cannot control your body weight. You can't even help them. Okay? So they put me on that stretcher and then, you know, very fast go there already. Okay? Just check in out only, it cost me about 1,000 plus. Wow, very expensive. Okay? So you have to take care of yourself. So medical care is very important. So I should have checked in at the GH then I automatically is a member already. Okay? So that is how it works. Of course, we have already checked with other retirees. So medical care important, insurance also important. Other long-term benefits, you have what? Long service leave or sabbatical leave. Jubilee means on anniversary of your service, maybe 30 years anniversary, 20 years, 10 years anniversary. Long service benefits. Long-term disability benefits. Okay, so these are other long-term benefits, yeah? Then you have termination benefits. So like I mentioned, termination benefits are those what? The employer so decides to terminate your services. Maybe because they're downsizing, maybe because they're closing down the factory, etc., etc. So you see, as a result of what? The entity's decision. So which means it is not your decision to leave, but the entity's decision to ask you to leave because of something. Okay? And then of course, they cannot force you unless it's closing down. Okay? But they also need the employees to accept the decision. Okay? So this is like what I mentioned, VSS, Voluntary Separation Scheme. Okay? So it's like, you know, they ask you to leave, they compensate you. All right? So these are some of the definitions. Definitions very boring. But we still need to look at them because it will help you to understand. Okay, so employee benefits. This, of course, is in line with the standard MFRS 119. That says what? All forms of consideration. It could be in kind, it could be in monetary. Okay, post-employment means what? Those that is eligible to be collected or to be paid by the employer to the employee after the completion of employment. That means after you retire. Okay, what is the normal retirement age in Malaysia? What is the normal retirement age in Malaysia? 60, 60. Well, of course, in Utah, after 60 already, they may give you contract, okay, for 1 or 2 more years. Then post-employment benefit plans. Okay, so benefit plans, they are formal or informal arrangement under which the entity provides post-employment benefits for 1 or more employees. So which means that there will be a certain plan given to you. Okay, what kind of plan? You have the first plan, you have the second plan. Defined benefits plan. Defined benefits plan means that how much you are going to get at the end of the day as a retiree is already determined, defined, they already know. So if like you are a pensioner, you would know how much you're going to receive when you retire. So let's say the standard is 50% of your last pay. So that will be your income until the day you say goodbye on a monthly basis. But you do not need to provide any more services. Okay, that is why we say it's a post-employment. Then you have the next one, which is a defined contribution plan. So that means the contribution to the plan is actually defined. So this one, you can use the example in the Malaysian context. This is a pension scheme. Okay, pension. And then the other one, defined contribution plan. This is the EPF plan. Okay, EPF. So EPF, how much the employer pays towards this particular EPF plan is already defined. They know. Let's say 13% of the staff salaries must be paid by the employer to go to the EPF fund. So define. Define means already determined. Okay? That's why they tell you post-employment benefit plans, because both are post-employment benefit plans, and this under the EPF is where the entity, that means the employer, pays a fixed contribution into a fund, and after they have made this particular payment, they have no further legal or constructive obligation to pay further contributions, even if the fund does not generate sufficient to ensure that you can live comfortably after retirement. Okay, so which means we talk about the obligations of the employer is only up to the fixed contribution. But in terms of the defined benefit plans, which is a pension plan, the employer will have to continue to make sure that the pension money that the pensioners receive is sufficient. Okay, not enough, they have to come out from their own pocket and contribute to this particular pension plan. So the obligation does not stop there. Okay, so later your homework, you will be able to tell me specifically what are the difference between these two. Okay, so other long-term benefit plans, just now we have already mentioned. Of course, since they mentioned long-term, so of course something that you're going to settle after more than 12 months. Okay, termination benefits, just now we have already mentioned, is the entity's decision to ask the employees not to come to work anymore, and the employees must accept the voluntary redundancy. Okay, so this one will be like last week we talked about gardening leave. Okay, have I finished the short term with you? Short term finished already? Yeah, now I'm very confused. Okay, so vested employee benefits, those benefits that are not conditional on future. Vested means what? Entitled already. Okay, today you can collect. So if they tell you, we give you this particular benefit, the benefits will vest today. So you can collect everything today. No need to go and pro rata to and allocate to the next few years. Okay. All these terms from this particular page onwards, they are basically all those that you are going to see either in the defined benefit plan or the defined contribution plan. Okay. Let me just fast forward a little bit. This one. just want to show you the pro forma that you need to memorize. Okay. We are going to look at this particular pro forma that you need to memorize. Okay, so if you ask me whether MFRS 2, 1, 2, 3, 4, 5, MFRS 2 or MFRS 119, which one is less tricky? I will tell you that this one is easier. I mean, not to say easier, it's very straightforward. You just plug the figure, put in, plug the figure, put in, plug the figure, put in. Okay? Just now I checked already. How many marks? 12 marks. Okay? You have to remember the template. So if memorizing of the template, which means that now you must do it already. Anytime from today onwards, if I meet you, I ask you, present value of the plan obligation was the first item. Then you must immediately tell me, put in the balance at the beginning first. Like that. And then next. This is very, very simple. Only if you can follow instructions. If you are someone who cannot follow instructions, then you cannot do this question because you will go haywire. Okay? So, like I say, this is a template that you need to know. And the template is very simple only. Last time, this who put Mr. T.K. Wong used biscuit, but I find it very difficult to use. B-I-S-C, I think biscuit, C-U-I-T, right? I think the biscuit a little bit chat one, the spelling. Then you have biscuit, something like that. This is the balance at the beginning. Interest, service cost, S, B-I-S-C. Oh, C is a curtailment. Don't know what. I don't know how to use, so that's why I'm not using. Okay, so you just memorize it by heart lah. This is how the format should be. Okay, but the one soft, S-O-F-T, is very simple, so you can adopt that. Okay, this one I can't remember. I find it a little bit difficult because you need to rearrange. Okay, so I don't want to rearrange. Okay, so those items in the pro forma is what we are going to look at here. Okay? So, memorize. What you can do is cut, or snap a picture, put inside your phone, whenever you're waiting for the bus, waiting for your lunch, just look at it. Okay? Don't go and scroll the Instagram. Okay? So, present value of the defined benefit obligation. So you see there is two sides to it. One is the obligation, another is the planned asset. Okay? So just now you have seen the diagram, right? There is two sides. One is the present value of the obligation. The other side is the fair value of the planned asset. So what is the meaning of the present value of the defined benefit obligation? So they tell you it's the present value without deducting, blah, blah, blah. But do not memorize the terminology or the definition. I am not asking you on that. Okay? Otherwise, you will spend a lot of time going to memorize each and every word, one comma, one full stop, one, not necessary. If you know me, I don't really like definitions. Okay? But concept, yes. Concept, I love it. I don't really ask that much on definition unless I just want to help those students who are good at memorizing. Some of the students say, Miss, I cannot pass the exam because you give all calculation. I'm very good at memorizing. Can you please insert in some questions that requires memorization? Definitions, but usually instead of asking definitions, maybe we ask you comparison. Okay, then you have to use your kepala a little bit. Okay, so this one that says present value of the defined benefit obligation. to settle the obligation as a result of the employee service in the current and prior periods. So maybe what I can do, actually, just explain very briefly what this means. Okay, so you see, you have something like this. This is your working time frame, okay? Until the day you say goodbye. This is GB, goodbye. Okay? Of course, before you say goodbye, hopefully that is the normal trend. Before you say goodbye, you already retired. Okay? Well, of course, this one is something that we cannot control now. Okay? So let's say this is the first day that you enter the workforce. You are part of the workforce. Okay? You graduate already, you start here. Then every year you work until the day you retire. Okay? So as you work, that means you are contributing services to the employer. Let's say you work for this particular company your whole lifetime lah. From the day you graduated until the day you retire, then this is the only company that you have served. Okay, just hypothetically lah, but try not to do that lah. Because if you do that, what is going to happen? Last pay will be very low only, because it's like a snail speed, we call it. When you work within the same company and then you wait for every year's increment, until the day you retire, your salary is very small, very, I mean, not much only. Okay? You need to do what? Jump. Okay? When you are prepared. Then every time you join another company, you ask for 30% increment. Of course, you must be good lah. No good, then don't ask. They'll just reject you. So as you provide the services until the day you retire, okay, of course, we're talking about this is a defined benefit plan, which is a pension scheme. Because defined contribution plan is very simple only. Okay, so of course this is a pension scheme. So the workforce will work until the day they retire. And as they provide the services, as this workforce provide the services, what happens on the employer side? Employer's obligation will increase. Employer's obligation to pay them their pension money when the staff retires will increase. Correct or not? If you think about the pension, every don't know how many years you work, you jump the scale. Maybe at first is 10% or 15% of your last pay. If you work for, let's say, 5 years before retire, But if you work like your entire working life, maybe like 30 years, then they will tell you, you will get the maximum 50% of your last pay as a pension. So in other words, the longer the employees service the employer's obligation to pay them the pension money increases. Okay? But this particular obligation will keep accumulating, but will not be paid to the employees until they retire. Only this time, from here onwards, they start to pay. All right? This one, we will say benefits pay. Okay? Because later in the pro forma, we have one that says benefits pay. Okay? And at the same time, how do you think that the employer will have money to pay the benefits when the employees retire? They must contribute. Correct or not? they must contribute money to the plan. Okay, they must contribute to the fund. Okay, and suppose if my projection is very accurate, every time the employees work for me year after year, year after year, I contribute money into the pension. And then, of course, when I contribute the money, there will be fund managers. The fund managers are going to go and do reinvestment, investment, and then hopefully the returns will be sufficient to pay off the retirees when they retire. But if the funds is not performing well, which means the employer's obligation is still there. Employers still have to contribute more money to the fund so that the fund has sufficient money to pay to the retirees when they retire. I mean, to the employees when they retire. Okay? And of course, this particular process is ongoing like this. All right? So, which means the funds that the employer contributes, they are going to do investments. Those investments will be in the form of buying plan assets. Okay? So this particular plan assets fair value supposed to be equal to the present value of the employer's obligation. Supposed to be equal, because we say that present value of the plan obligation versus the fair value of the plan asset, suppose these two should be the same. Right now, employers say, I already know how much I need to pay to the employees when they retire, so I contribute. So according to the speculation, the so-called forecast, I should have enough. If I don't have enough, then there will be some difference. So the difference is what we call the remeasurement gains or losses. Okay, so later on we are going to look at this. And of course, you will know that this particular plan asset, you are not going to pay to the employees until they retire. So which means that if you have plan asset, it will also generate interest income. And your obligation the same. You just accumulate your obligation until the day the staff retires. So which means that you also have accumulated the interest cost. So later we shall look at all these. So come back to this one. Obligation, okay, so this particular obligation will build up as the employee works for the employer. So this is what we say. When they work, the employer's obligation to pay them the pension money when they retire increases. Okay? Then current service cost is this cost. This salaries that you pay when the employees actually services the employer. Okay? So you have the current service cost. Increase in the present value of the defined benefit obligation as a result from employee service in the current period. So that means every year, every month you provide the services, it will go on and on and on. The more you work for the employer, the higher the employer's obligation is when you retire. Interest costs, this is the one because they tell you that you're not going to pay them first. You're going to wait until when they retire. Okay? So increases during the period in the present value of the defined benefit obligation, which arises because the benefits are one period closer to settlement. Okay? So every time you accumulate, the interest cost also will accumulate. So which means here to here is the obligation side. Then you have the plan asset side. So plan asset comprises of what? Assets held by long-term employee benefits plan and those qualifying insurance policies. So that means they invest. The employer are going to put their money into some kind of asset, and the asset is supposed to generate sufficient to get ready, yeah, all right, to meet the obligations when the employees retire. Okay, so fair value, of course, this is a definition in line with MFRS 13. Okay, fair value definition is actually everywhere. When you talk about your consolidation, you also talk about fair value of the net assets. So, which means that they are actually in line with MFRS 13. And when did you study MFRS 13? It was some time ago. This is part of the syllabus of FA2, long time ago. Okay? But the definition of which is something that you must have at fingertips. The price that would be received to sell an asset or paid to transfer a liability in an orderly transaction between market participants at the measurement date. You must know that MFRS 13 is actually market perspective. It is not entity perspective. Okay? And then return on the planned asset. This is the interest component. Okay? Because you buy the assets and then you are supposed to make sure that this particular asset generates some income, etc., etc. So this is the I portion, interest income. Interest, dividend, other revenues derived from the planned asset. Okay, then if the two figures, the obligation does not tally with the planned asset, you will find that you would have ended up with some actuarial gains or losses. That means the balancing figure. Okay. Past service cost, this is also under the obligation, under the planned obligation. Past service cost arises because of changes. All right, changes to the plan. Change to the plan. Maybe the employer have done some modifications to the plan that resulted in some past service costs. Past service costs you must also take into account. So the past service cost could either be positive or negative. Okay, so it could be like when you make changes, the past service cost increases, or because you make changes, you find that there is some savings. Okay, this is my standard answer for the difference between these two. Easiest, you take note of the example. Defined contribution plan, which is very simple. It's just a matter of making an accrual. All right, defined contribution plan is actually your EPF. Huh? I left blank, meh? Oh, okay lah, you fill up. The other one is a defined benefit plan. Defined benefit plan, pension scheme. I don't know how you're going to remember lah, but you must remember them lah. Okay? Do not mix up the two, right? Do not mix up the two. If you mix up the two, habislah your 12 marks. This one is your BQ3. BQ3. All right? Question 9. BQ3 on this particular topic, MFRS 119. Okay, so you can see over here. Of course, this one is very simple only lah. We just talk about defined contribution plan. So you think about EPF. What happens in EPF? Employer just pay the 13% employer's part of the contribution to the EPF funds. At the same time, of course, the employer will also deduct from the employees and put them into the EPF funds. Okay, and then after the employer have done that, after the employer have done that, the employer have no more further obligation. Okay, let's say you just because I think the EPF now is also, I also don't know what to say. They allow a lot of people to withdraw before they retire. Okay, don't know every month can withdraw how much. Okay, so of course Being a contributor to the EPF, we're also very scared, right now, because let's say I don't withdraw. I hope that the money will be available when I retire, okay? But we must make sure that the money is there, Otherwise, you only have the so-called the statement only the figures stated down there, but no money on. Also very scared, okay? So I don't know, maybe I should withdraw, okay? In terms of EPF in Malaysia here, we have two different accounts. One is 55 years old one. Then thereafter, there is another one that is from after 55 to age 60. Okay, that is another fund. So right now, I should be able to withdraw everything of the 55 one. Okay, but the one from after 55 to 60, you can only withdraw after you reach 60. Okay, so this kind of restrictions to withdraw. Okay. Employer pays regular contributions to the plan, and then this one is as a certain percentage of the employee's salary. An important thing is what? Employer have no further obligations thereafter. Okay? Let's say if I retire already, I finish using all my money, I gamble away, I go and contribute to the flower pot in Gotong Raya. All the flower pots. Okay? So nothing already, no money. Can I go back to the employer and say, I've worked for you for 20 over years. Can you pay me more? Employer say, sorry, I have no further obligation. Okay? So the annual cost to the employer is reasonably predictable. So they know how much of your salary, their contribution is so much of a certain percentage of your salary. That's all. Actuarial and investment risk, it falls upon the employee. So let's say if the EPF fund managers are not doing their work properly, they are making a lot of bad investments, then of course, my so-called interest will be very low. Okay? It's just like they also have one that called PRS, Private Retirement Scheme. I contributed because they tell me I can get relief for the income tax. But from the last check, actually I don't care one. Because the say maximum is 3,000, so every year I contribute 3,000 only to the funds. Okay, because tax exempt is only for 3,000. But then I pay 3,000. I think at the end of every year, the performance, my money becomes shrunk, 2,000 something. Next year it becomes shrunk again. Okay. So I don't know. Maybe this year I shouldn't contribute just to take the tax advantage. Okay. So falls on the employee. So the size of the post-employment benefits paid depend on how well the plan has performed. Okay? Pension. Employer agreed to provide benefits to the employees, and it is set at a certain amount. Let's say 50% of your last pay. Okay? Size of the pension depends on the final salary or the average salary, and this particular cost of providing the pension varies from year to year. All right? You see, even in the overseas, in UK and all those, their pension scheme, our equivalent of our pension, is also suffering, because over there they also pay people for unemployment benefits. Okay, but in Malaysia here we don't have such things. So over there, sometimes you see the people are lazy because, I don't know, maybe lazy is not the right word. They just don't want to work. But they will still get money from the government. Okay, they call it unemployment benefits. The unemployment benefits is sufficient to continue living. Not luxuriously, but sufficient. You don't have to sleep on the streets. Okay, so that will be a burden to the government. All right, so also in terms of the defined benefit plans, the obligation falls on the entity. if whatever that is kept in the defined benefit plan assets is not sufficient to meet the obligations, then who must come out with the difference? The employer must find other resources to make up for the shortfall. All right? Employer is still liable. This is the homework. But of course, this one I don't want to discuss now. Okay? This one, I get it from where? ChatGPT. I don't know whether you have done your homework or not. If you haven't done your homework, you just go and do your homework. Then you compare against what is this. This one, since it's recorded, you can always go and look at how many minutes of the recording to go and find. Okay? This one, I also go and ask ChatGPT. So the answers is very much more comprehensive. So the first thing, they talk about nature of the plan. This one I didn't do anything on. I just copied direct. Okay, measurement, accounting treatment, risk exposure. Okay, so you go and do something about it. All right, so now we look at the easier one, the EPF, defined contribution plan. So we already know that the defined contribution plan means that the obligation of the employers is limited to how much they need to contribute to the EPF funds. All right, so employee will receive the contributions made to the funds and the returns on the contribution. So of course, this is how much that will be available to the employees when they retire. And in this case, you will find that there is no actuarial assumptions necessary. It's just an accrual adjustment only. You just need an accrual adjustment. So, which means that if the employee is under the EPF scheme, every month the employer still has to pay on top of the normal salary a contribution to the EPF funds. So they will put it as debit the expense or debit the staff cost and then credit the cash if they already made the payment. If they haven't made, they have to accrue for it. Okay? Any payment that is more than 12 months, you have to take into account time value of money. Okay? So this is the illustration, defined contribution plan. So it's very simple one. Did I give you the answer? Ada. Okay, so you just look at the question first. Marina Berhad employs 600 people and has a total salary bill of 24 million per annum. Okay, 24 million per annum. Company pays 8% of the salaries into a defined contribution plan. So which means when you look at this kind of question, you have to determine whether it's EPF or pension. Okay, so this is a defined contribution plan. Defined contribution plan, the example is the EPF. Okay, because the contribution to the funds is defined. Okay, 8%. In the current financial year, Marina Berhad has paid. So far, they have paid and charged to the SOPL 1.8 million to the scheme. Okay, so suppose they need to pay what? 8% of the salaries. How much is the total salary bills? 24 million. So 8% times by 24 million, the contribution of the employer to the defined contribution plan, which is the EPF, should have been 1.92 million. But so far, the company, the employer, has only paid 1.8 million. So which means that the difference between 1.92 and 1.8 million is an accrual. Okay? So to the SOPL, as part of the staff cost, it should have been 1.92 million. How much the employer has paid? Cash 1.8. So which means 1.8. Over here, the accruals is the difference between these two, 1.8, 0.8. million. So this is the only kind of entry that you need to enter for a defined contribution plan. Okay? Do you think that this kind of question will come out in the final exam? Huh? You think this kind of question will come out in the final exam? Accrual adjustment. Accrual adjustment is just like an adjustment that you learn in FA1, but you are now in PCR. If I ask you this kind of adjustment, that means what? I'm giving you early Christmas present. Okay? But this year I'm not so generous. More focus, defined benefit plan. Defined benefit plan, you must know. You must know. Okay? Defined benefit plan is the one with the pro forma. Defined contribution plan is just an accrual adjustment. That's all. So nothing much. So they tell you defined benefit plan more complex because of actuarial assumptions, blah, blah, blah. Okay? Important thing is employee is guaranteed how much they're going to receive when they retire. And who guarantees this? The employer. Okay? So employee is guaranteed specific amounts of benefits that will be receivable by the employee after they retire. So many years after the employee rendered the service means that after they retire until they say goodbye to the world. Okay? So it could be a lump sum payment such as gratuity or a periodic payment such as pension. Okay? Gratuity usually is a one-off payment. Periodic payment will be every month you go to BSN there, you take a passbook, you know, or your IC, you go there, withdraw, withdraw, withdraw. That one is a monthly kind of periodic payments. Then the obligation to provide the agreed benefits are all borne by the entity. So when you want to explain about the difference between these two plans, important thing, you must cover the risk, okay? Because it's so much different. The accounting treatment, you also must mention. The rest of it is up to you what you want to write, okay? See whether when you go to ChatGPT, you get the same answers as mine or not. Who? Chen Hui. Same or not? You do the homework already, guys? Haven't. Oh gosh. You know you must do, but you still don't want to do. It's just like me. I know I must submit my income tax, but I still got no time to submit. Okay? Until income tax comes after me. Okay. So now define benefit plans, the steps. Actually, this one, you make some amendment because I think I put down at the wrong row already. So past service cost should be under present value of obligations. Okay? So you have steps. But of course, later on, after I explain the illustration already, you don't really need to do the steps 1, 2, 3, 4 like this. But of course, for explanation purposes, we tell you, oh, you must go to step 1, step 2, step 3, step 4. Okay? So what is important is what? You must know your pro forma. Pro forma, you must know by heart so that you know what to extract. Opening balance, closing balance, what goes in between. Okay? So you must know that your pro forma, you have two sides. One is the present value of the obligation, another is a fair value of the planned asset. So remember, this is present value, obligation, fair value of the planned asset. Okay? And these are some of the components that goes in between the opening and the closing. Okay? And then balancing figure is the actuarial gains or losses. This is the balancing figure. Then you also need to find out what is the net defined benefit asset or net defined benefit liability. So if you get the net defined benefit liability, because remember I said we have two parts, right? We have one present value of the planned obligation compared with the fair value of the planned asset. If let's say this present value of the planned obligation is 1,000, okay, and the fair value of the planned asset, let's say, is 800. Let's say this is at the end of the period. So which means 1,000 obligation versus 800 of the planned asset. So you are going to end up with net defined benefit plan liability. If you end up with a liability, it's okay. So you just record whatever it is. But if you end up with a net defined benefit plan asset, you know that accountants are very what one ma. So if they end up with something that is of asset, they say, oh, we have to investigate further. What is the investigate further? You have to subject it to asset ceiling test. This one, subject to. Having said this, remember your MFRS 112. When you have deferred tax asset, we also say that, oh, deferred tax asset, hold on first. We want to see whether the entity will be able to generate sufficient future profits to offset this particular deferred tax asset or not. If you cannot provide those evidences, they will tell you, don't record. But if you can, yes, then you can record your deferred tax asset in the books. Okay, so here the same things. If you ended up with having a net defined benefit plan liability, they say this is okay, just reflect it in the books. But if you end up having a net defined benefit plan asset, they say we have to subject it to asset ceiling test. Later we will look at that. And of course, in terms of defined benefit plans, we want to know how much is it that will appear in the SOPL as part of the staff cost. Okay, what items will go to the SOPL? And then later, we will also want to know any remeasurements, gains or losses. Any remeasurement gains or losses will go to the components of OCI, other comprehensive income in the SOPL. Okay, so this one, blah, blah, blah. So do you see that? This one is just basically they tell you how they compute. But of course, we are not so much interested in how they get the opening balances, the closing balances. These are the work of the actuaries, you know, the actuarial sciences students, just like those who work in the insurance company. How do they know that based on don't know what data, what modeling they have done, if you pay this premium, for how much sum insured, for how long, you know, what other risk areas, blah, 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 the insurance company will not go bankrupt. Okay, so of course, how do you know how much you have to pay in terms of your insurance premium? They have already calculated. So same things here. Whatever is the opening balances, closing balances, they already done some kind of modeling. Okay, so some of the articles or the books that you see, they will tell you they go by projected units credit, projected unit credit method. So I also don't know how it runs, but they just like, you know, you just assume that it's like a big model. So you input in. So that's why when you want to see how much is your insurance premium, the insurance agent will ask you, what is your age lah, some more what? Whether do you smoke or not, do you drink or not, you know, what's the medical history, blah, 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 blah. All these imputed inside as some of those variables. And then they say, this is how much your premium is. Everyone's premium is not the same. Okay, so they impute it. Like for example, over here, demographic, staff turnover, mortality, salaries, medical costs, blah, blah, blah. So they use some kind of actuarial science, actuarial technique, come out with the figures, okay? And of course, if you talk about obligation, they will discount it, okay? So you have a present value of the obligation. Planned asset, they will come out with the fair value of the planned asset, okay? Just to have an idea of how the so-called units of projection method come about. So you look at this illustration too. Employees entitled to a lump sum payment of 15% of the last drawn salary for each year of service on leaving the service at the end of 5 years. So that means this particular employee is going to retire in 5 years. After they retire already, they are entitled to some pensions. And this pension money is calculated based on what? 15% of the last drawn salary for each year of service. Okay? So currently, this particular employee's salary is at 50,000 per annum. So 50,000 per annum. Actuarial assumption is that the salary will increase by 10% per annum. So that means every year the salary should increase by 10% and then 10% on top of the 10% and so on for the next 5 years until this particular employee retires. Because you need to calculate what is the last drawn salary. Okay, discount rate, if required, is at 10%. So determine the annual staff cost using the projected unit credit method and the present value of the obligation. Okay, so they tell you the details are given to you. One staff pension money will be based on 15% of the last drawn salary for each year of service. Okay, so employee earns benefits over the 5 years of service, although he will be paid only after he retires, which means after 5 years later. Amount paid has to be based on his last drawn salary. So how do you calculate his last drawn salary? So over here, they already inform you. His current salary is 50,000. So today he's earning 50,000. 1 year from today, he's going to be earning 50,000 times by 1.1. So we just year on year on top of each other. This is the first year, second year, third year, fourth year, fifth year. So by the time you calculate all these, by the time 5 years is up, his salary at the end of the 5th year is 73,205 per annum. Okay? So this one also very little only, maybe it's USD, maybe convert. In UK, per annum salary, for fresh graduate in accounting is about less than 20 over £1,000. Okay, this one is if you go to join the Big Four, okay, it's about 27,000. But they pay you, they subsidize, how to say, they pay for all your examination fees. They will ask you to sit for professional examination. They ask you to work as well. So it's about 2,000 plus only, or less than that. Okay, so this much. Then final salary that will be so-called paid when they retire will be what? Final salary, you know that you will be paid 15% of the last drawn salary. 15% last drawn salary for each of the years of service, so times by 5. So which means at the end of the day, this 54,904 is the final so-called contribution towards the pension funds. So for each year, the unit of obligation of the employer will be 10980. So which means that Every year, the employer must make sure that they have contributed so much in order to meet the obligation when the employees retire 5 years to go. Okay, in 5 years' time. Then this one is talking about all those components in the template. So I will just highlight to you what are the keywords, yeah? Opening balance, closing balance, end of the year, closing, opening balance, closing balance. So I say you cannot get 0 for this question because it's plug, put, plug, put, plug, put, but must plug the correct figure. Okay? Increases, this is your interest. Interest, because this is an obligation, so this will be interest cost. Okay? Interest cost. And this interest cost is calculated based on the opening balance, based on the opening interest rate. Because the question will give you more than one interest rate sometimes, and then you need to choose. So just remember, interest is based on the beginning of the year's interest rate times by the balance at the beginning of the year, or beginning. Okay? And during the year, you may have current service costs, and sometimes you have elements of past service costs. Okay? Then you have benefits paid. All right? And in between here, you will have the balancing figure. Okay? So opening, closing, interest based on the balance at the beginning, based on the rate at the beginning, current service cost, past service cost, benefits paid, balancing figure. Can you do that? So it's here. Opening balance, closing balance. Because these two always given by the question. If you have the last 1 minute before we say time's up, just put in opening, closing, because it's given by the question. Then calculate the interest. Let's say the interest here is 6%. Take 6% times by the balance at the beginning, and you can get this figure. Okay? So you see, balance at the beginning is the obligation, present value of the obligation at the beginning. So all these are obligations. They are not the asset side, not the income side, so that you can just jumble. Then put in the current service cost, put in the past service cost. Benefits paid, remember what did I say? Benefits paid will be towards when the employees retire. So what happens? When the employees get paid their pension when they retire, the obligation of the employer will reduce. Okay? This one, remember, current service cost, as the employees serve the employer, provide the services, the obligation increases. So that's why it's jumbo. So when you go until the component of the benefits paid, when the benefits are paid to the retirees, the obligation reduces. So you must know which is the figure that you need to put brackets. The rationale is because now that you pay already to the retirees, of course your obligation will reduce already, okay? And this one is a balancing figure. This is a balancing figure, okay? So how to find the balancing figure? So suppose you have all these figures, campur tolak, tolak this one. Let's say this one you get 1,000. Subtotal, how do you get to this balancing figure? Compare with whatever that you have extracted, which is the closing balance. Let's say the closing balance here says 1,200. And these closing opening balances are done by those actuarial assumptions. So the question will give you. Okay? So which means what? If you have 1,000, an output of this campur tolak here, right? And this closing balance to 1,200, that means there is a 200 that you need to insert. Because this, take into account this, must equal to 1,002. Okay? So you think about it. This 200, is it a gain or a loss? So you don't need to go and memorize. What you need to do is logical thinking. This is an obligation. According to your computation, your obligation should be at 1,000 only. But the actuaries, they come out with the correct present value of the planned obligation at the end of the day, which means my obligation increases. If my obligation increases, this is a loss on remeasurement. Understand? So that the reason why I explain to you this way is so that you don't have to remember. A bracketed figure is a gain. Non-bracketed figure is a loss. So you just talk about the rationale of this. Okay? So this is a loss on remeasurement. Follow? Then we can look at the fair value of the planned asset. So it's the same things. So opening balances, opening, then closing balances. Then the employer must make contributions to the planned asset. So contributions made to the planned asset. Of course, you also need to calculate the interest. And this interest, because they are based on the asset, you will have interest income. Okay, interest income. Benefits paid, because when the employees reaches the retirement, you will have to pay them their pension. And when you pay them the pension money, the planned asset will decrease. Right now, money paid out from the pension funds, planned asset will decrease. So you can just imagine on the template what is going to happen. You have to put a bracketed figure for the benefits paid. And you will see that this benefits paid appears in the planned asset and it also appears in the planned obligation. This is the only item that both also will appear. And when they appear, bracketed, bracketed. Okay, so opening, closing, interest 6%. 6% interest at the beginning times by the beginning of the year balances, some interest income. Contributions made to the plan, that means when the employer puts in more money to the pension funds, the plan asset will increase. So, campur. Benefits paid, when the plan pays to the pensioners money, of course, the value of the plan asset will decrease. So it's a bracketed figure. Okay, so you draw a line here because we want to find out what is this balancing. So assuming here is 800. Here, whatever figure, let's say here, what figure do you want? Let's say 700. So what does it mean? According to your computation, blah, 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 beginning of the year, until here, you should have 800 as your planned asset. But the actuaries come back and say, oh, based on the assumptions that we have put in, you should only have 700 as the fair value of the planned asset. So for you to get from 800 to 700, you must insert in a bracketed 100. Agree or not? So, in other words, what? Suppose the asset is so much, but then now you say so much, I rugi. So, this is a loss. Understand? So, you don't go and memorize. If let's say this is 800, this is 900, 950. So, which means the difference is 150. 150 is the gain. Understand? Because according to your Champotola, you should only get planned asset worth 800. But then the actuary say, oh no, when we compute, we know that the figure should have been 950. So you make a gain of the difference. Okay? Taking both into account, we will see this as the balancing, this as the balancing. Okay? So, in other words, you are going to have some figures, some figures, some figures, some figures, bracketed, some figure. Don't use this highlight. Okay. So you will have some figure here, some figure, some figure, some figure, bracketed figure, some figure. Okay, same goes here. Some, bracketed, some. Okay, so now the question is, what goes to the SOPL? What items goes to the SOPL? Items that goes to the SOPL will be these items. Interest, current service cost, past service cost. Okay? But you don't show one by one. Let's say, for example, interest cost is 60. Interest income 50. Then you show 10, which is the net interest cost. Because the cost is more than, this is the cost, obligation, this is the cost. The cost is more than the income. If the other way around, then you will put net interest income, okay, to the SOPL. Current service cost, copy. Past service cost, copy. Okay, because these two figures don't have the equivalent on the other side. So no need to tolak, no need to take the difference. But the interest has appears on both sides. So one is interest cost, one is interest income. So you take the net to go to the SOPL. Okay? Then gain or loss on remeasurement, whatever the figure here, compare with the figure here. Just now, what do we have? 100 loss. The other one? Okay. 200 loss. Okay. 100 loss, 200 loss. It was 200 loss, 100 loss. So this will go to the OCI component. All right. So this is loss, this is loss. Loss and loss, more loss, right? So you just say loss on remeasurement, 300. Loss on remeasurement. Okay? Cannot erase. What goes to the SOFP? SOPL is here, ma? And the other comprehensive income, SOFP, beginning, end. So take the difference between this figure and this figure. This is your comparative figures because it's the beginning of this year, which is the same as the ending of the last year. Okay? So if let's say this figure is 1,300, let's say this figure is 1,500. So you have a what? Obligation more than the planned asset. You ended up having a net defined benefit plan obligation 200. Okay, at the beginning of the year, which is the closing of the last year. Then closing of this year, let's say this one is 3,100. This is 3,000. So you're going to have net defined benefit plan liability 100. Okay, and of course, this is for the current year. Understand? And you can take a picture of this if you want. Don't want also doesn't matter because later we have questions to do. Yeah? So remember this balancing figure, which is a gain or loss on remeasurement, you are going to show it under OCI, other comprehensive income. So, like I say, this is the important template. If you don't know what the question wants, just give me the template. Okay? Past service costs. This one talks about those elements in there. So, like we say, past service cost is because of modifications to the plan. So sometimes the past service cost will increase. Sometimes the past service cost will have a negative figure. Okay? So past service cost may arise because of changes that has been introduced. Changes, and usually the past service cost, you have to recognize it immediately if it's already vested. If it's not yet vested, then you spread it over the remaining how many XX years based on straight line. But past service cost, you have to carry it to the SOPL. Okay, you look at illustration 3. I give you the answers. Yes, sir. So entity introduce a defined benefit plan for the all its employees who have served 5 years or more. Okay, so that means they just introduce that. They say that we are going to put you on some pension scheme. If you have worked with me for 5 years, then you are entitled. Okay, then what happens? 10 employees have worked more than 5 years, and the rest have on average worked for 3 years. So because everybody joined the company different timing, so for those who have worked for more than 5 years, that means the benefits for these 10 employees will vest immediately. Okay, but as for those remainder, the rest, who only work for 3 years, then their so-called the past service cost will be spread over the remaining 2 years based on straight line basis. Okay? This is when you ended up, just now we have mentioned from the examples given, all beginning as well as the end, you still end up with a net defined benefit plan liability. Liability is okay, just reflect it in the books. So now, if you ended up having a net defined benefit asset, so you have to carry out the asset ceiling test. Okay, so this is just like in your assets, like your PPE and your intangibles and whatever not. We always say what? Assets cannot be carried at above their recoverable amount. Okay, so this is a so-called the sentence that you must always tell yourself. Should you provide for impairment or not? So you always tell yourself, assets cannot be carried at above the recoverable amount. So your asset ceiling is something like a recoverable amount. So no need to memorize what it is, but the definition of the asset ceiling is very long one. They will tell you. Oh, no definition also. Let me see. I also cannot remember the definition, but the information about the asset ceiling will be very long one. Okay, they will blah blah blah. Later, I think in the tutorial I do have. Okay, so asset ceiling threshold is to ensure that any defined benefit plan asset is carried at no more than their recoverable amount. So they will probably tell you the asset ceiling is what? In the future, the amounts that you can recover from this particular asset is XX amount. So it's like a recoverable amount like that. So, which means that if you ended up with a net defined benefit plan asset, before you reflect this as part of your non-current asset, you have to subject it to asset ceiling test. So asset ceiling test. So this particular asset ceiling test says what? Find out how much is the net defined benefit asset now. So let's say net defined benefit asset is 1,000. Then asset ceiling will always be given to you. They will always mention, how much is it that you can recover from the use of this asset in the future, blah, 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 discounted. So let's say asset ceiling is 800. Compare these two. The lower figure will be the net defined benefit plan asset to be reflected in the SOFP. So you choose the lower of the two, okay, to become net defined benefit plan asset to be reflected in the SOFP. So what happens to the difference between these two figures? The difference between these two figures, which is 200, the 200 you have to reflect it under the OCI component in the SOPL. Okay, but alternatively, if you have this as 1,000, which is a net defined benefit plan asset as 1,000, asset ceiling, let's say you have 1,100. So what do? Compare these two, take the lower thereof to be reflected in the SOFP. Then the 1,000 compare with the 1,100, the 100, what do? You put it in the OCI. Why is it at the end there's a question mark here? Is it correct or not? Just like your impairment. Because remember, in your final exam, there is this MFRS 5, huh? MFRS 5 also needs you to know about your impairment, huh? Right, huh? Because MFRS 5 says what? Compare the carrying amount with the fair value less cost to disposal. Take the lower thereof. Okay? The difference goes to as part of the impairment loss. Okay, so this one, the one that is in purple is correct, right? Because your net defined benefit plan asset is 1,000. You already have it recorded in the books 1,000. But then when you go and compare with the asset ceiling is only 800. So which means you need to write down the asset, right? So the 200 must go to the OCI. Then you look at the red, or actually this is a brown one, okay? 1,000 or the red one, 1,000 net defined benefit plan asset. And they tell you asset ceiling is 1,100. And then we know that the rationale for this comparison is because we say what? Assets cannot be carried at above the recoverable amount, or assets cannot be carried at above the asset ceiling amount. So, is there any necessity for us to bring the 100 to the OCI? No need, no need, no need. You should still copy it and put a big cross here. Maybe we should use the highlighter. No need. This is already correct. Okay. Understand? Okay. Only subject to asset ceiling when you have net defined benefit plan asset. If you have net defined benefit liability, okay, just record only. No need to do the asset ceiling test. Understand? What you disclose in the SOFP, just now I've already mentioned that. What you disclose, you compare. All right, you compare. But of course, this is just to get to the net defined benefit assets or liabilities at the end. Okay, so no need to reflect all these. This is the process. Okay, from the beginning until the end. SOPL, current service cost must go to the SOPL. Net interest on the net defined benefit liability or the asset. So which means you're going to take the interest cost, compare with the interest income. Take the net. If the interest cost is larger than the interest income, you will have net interest cost. The other way around, you will have net interest income. Curious gains or losses, this will go to the OCI component in the SOPL. Past service costs will be reflected as part of the item in the SOPL. This one, gains or losses on curtailment or settlement, is another item that will go to the SOPL. Only the gains or losses. Curtailment means what? You're going to reduce, you're going to downsize. It's called curtailment. Settlement means that maybe you don't want to participate in the pension scheme anymore. You want to shift all your employees to, let's say, contribution plan, to the EPF plan. So you settle the old plan, okay? When you settle, you have to pay, all right? And then versus what you get back, so you will get a gain or loss. Curtailment also, you will get a gain or loss. Any gains or loss on curtailment, any gains or loss on settlement will go to the SOPL. This is when curtailment occurs. This is when settlement occurs. Curtailment, you're going to close down the operations. You're going to restructure an operation. So you are going to downsize. Material deductions, you're going to downsize. Okay? Let's say your company has 1,000 employees, but because you close down the factory, which contributes to the major part of the operations, then employees you have to let go. So you curtail your business operations. Okay? So curtailment, settlement. Settlement means that what? The entity terminates any legal or constructive obligation, such as when the employees are paid lump sum cash payment or payments made either to the employee on behalf of them to another post-employment benefit plan. So it's either the employee just want to leave, let's say. They want to change to the contribution plan. So of course you need to settle one ma. It's just like when you're renting the house, after you graduate already, can you just pack and go? Cannot, you have to settle first. So when you settle that time, when you curtail the operations that time, you have to calculate gain or loss. Gain or loss goes to the SOPL. Okay, so it goes to the SOPL. So they're just telling you that, you know, what are those components that could make up the gains or loss on the curtailment. Okay, gain or loss on curtailment goes to the SOPL. Determine the remeasurement. This one we have already done already, how to do it. Just now I've already mentioned to you how to calculate. Okay, we do illustration 4. I hope I have left it blank. Have I? Blank or not? Blank, So you try. After you listen to me, blah, 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 you try. So, I don't want to disturb you, You do the same things. Opening, closing. First, you copy down the pro forma first. Then you take the opening, take the closing. Calculate the interest, put in all those that is in between. Okay? So pay attention before you do that. Even though the question say, just calculate the gain or loss on remeasurement, which is going to go through the OCI, which is your balancing figure. You are also supposed to give me the template. Is that understood? Don't just calculate on your own, and then campur tolak only, you just take a calculator also can. But I want you to prepare the template. Copy the template, put down all. Isi tempat kosong of the template. Then you tell me what goes to the SOPL, what goes to the OCI, what goes to the SOFP. Okay? How long do you need? 15 minutes. Okay? I go up there and come down. It's just like the doctor. When I go and see my doctor, want to take the blood pressure, you will just on the machine and then you go at the back. Then you come back. But still, pressure is high. Okay? All right. Next slide, Anyone still doing the question? Or I go, you also go? Huh? I go out, you also go out. I go out, you also go out. So when I do work that time, you better study also. Okay? Alright? Finish already? Can we get someone to tell us? I don't have the student version, never mind. How much is the balancing figure? Illustration 4, right? How much is the balancing figure under the column of the assets? Fair value of the planned asset, remeasurement. Any volunteers? If you volunteer, you sure pass one. Because I'll jot down your name, make sure you fail also. I'm going to make sure you take out the script again and see. Alright? If you deserve to fail, then of course cannot do anything. Okay? No volunteers? No takers? Okay, I see you next trimester. Okay, no need already. Why want to repeat the offer so many times? Right now, you want, you have taken already. You haven't seen those people that ask during the live show or whatsoever. They say, anyone wants $100 bill? Eh, nobody also. Alright, you don't want you don't want too good to be true. Okay, 1st Jan. Of course, the question says this is year end. Okay, so which means 1st Jan opening. So we plug the figures. Net define fair value of the asset. Asset 1100. 1100. Okay, so this is the fair value of the planned asset given to you. Obligation 1250. So just put 1250. So it's very simple, only one. Then you quickly go and look at end of the year, because these two are the simplest. Okay, so after these transactions, the fair value of the plan asset was 1.5 million. Okay, so asset closing 1.5. Of course, I can just say balance at the year end. Okay, or closing balance. And then present value of the defined benefit obligation 1553 600. So just copy balik. Okay, then you go and look at the ones in between. On 31st December 20X2, the plan received contribution from the employer of 490,000 and paid out benefits of 190,000. So this 490,000 is basically what? I should see here. This 490,000 is actually contributions made by the employer. When employer makes contribution to the plan, your plan asset will increase. So it goes under asset side and increase. Okay, asset side and increase. So this is the 490. And they tell you the plan has paid out benefits. Benefits paid. Remember, benefits paid is the one that you have to put bracketed at both sides, the asset and the obligation, because both also reduces. So this is the 190. So 190, first time you put under the asset component. Obligation, you also put as reduction in the obligation. Then the question says, current service cost 360. Current service costs will increase the employer's obligation to pay the pension when the employee retires. So, of course, the obligation side will increase by 360,000. Discount rate is to be applied to the net liability or the net assets. So this is the 6%. So which means the appropriate discount rate to go and calculate the interest cost or the interest income is 6%. So you have to take the 6% times by the balance at the beginning. Then you're going to get some figure. Take the 6% times by the balance at the beginning, you're going to get some figure. This is interest income. This is interest cost. Okay, but of course, I should have terbalik it because my template says obligation first, then asset the other side. Okay, so you just prepare a standard format. So after you finish all these already, anymore, nothing already. Then you need to calculate the balancing figure that goes to the OCI. So, which means what? This one, I need your help. 1100 plus 66 plus 490 minus 190. How much do you have? 1466 000. Okay, so which means what? The asset by way of your computation, it should only be 1466. But then the actuaries came out with the figure for the balance at year end. They say, oh no, the figure is much more. So you have to insert in a plus of 34,000. So this particular plus, is it a gain or a loss? Hey, the rest of the people, are you doing it or not? If not, I remove all the revision question, then you go study by yourself. Revision question, I also think so long already. What want to share with you? Cannot overshare, cannot undershare. I think I should overshare. Share some that is not coming out also. That is called overshare. Okay? Because you're too realistic already, Coming out, ding, the ear will open. Not coming out, ding, oh, z, away. Okay, next one, next one. Campur tolak, what do you get? Hmm? 1, 4, 9, 5,000. So your obligation is lesser than what the actuaries has mentioned. So you need to plus. So when your obligation is larger than what you thought it should be, larger by another 58,600, this is a gain or a loss? Huh? It's a loss. You give me the correct figure, you give me the wrong loss or the gain, you get 0 marks. Understand? Okay? You must give me the correct gain or loss. Okay, then what did the question want? Further, they ask you to extract your SOPL, OCI, SOFP. So, SOPL, SOFP. You need 2 volunteers, huh? Anyone want to volunteer? If not, I go and select randomly from your attendance. Spin the wheel. Number do you like? Not one, not the opening, not the closing. Okay. Somebody got calculator, right? Okay, we have about 150 students in this particular cohort. About, I can't remember how many. Okay, so what number do you like? 100. Huh? Come on. I got -5. -5. Huh? Okay, this is candidate number 1. Candidate number 2. I need 2 volunteers, huh? So what number do you want to start with? Huh? 88. We take 88 plus 48 minus 8, then plus 18, sama what? Minus 28. Wah, cukup makan dah. Okay, what number is this? What number is this? Huh? This is 2 What is this? Huh? 118. Wow. Yet fat. Every day prosperous. This one? 48. Save fat. So we go and see who the lucky draw is. Then they come out here and do today's attendance report. One. Today. first. Oh, this one really lucky draw, spinning, 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 spinning. See how long, if you ask me to update, I waste how long of my life to update this one for you. See, still spinning. Okay, what number? 48. 48. Lai Xiao Wei. Who is that? Huh? What minus 1? No, if you say minus 1, every time, just now it was what? 47.5. In the final exam, when I mark, the script is 47.5. I will put 48. If you tell me minus 1, I will let you fail. All right, 47. Okay, so who is that? Lai Xiao Wei. Ada? Lai Xiao Wei, Lai Xiao Wei, Lai Xiao Wei, once, twice. Don't have. Excellent. Absent also so long. Don't have, Lai Xiao Wei. Then what you want to add some more to the number 1? Already seen already, so cannot. It's not fair. What number just now? 118. Yeah, fine. Yeah. 142. You must add a few lah. Okay. What number? 118. Oh. Ti Gui Yun. Why everybody attended but not here one? Mana? Absent. You know, I hardly check one. When I check, I'm serious. But they are close by only. 96. See who is it that is very far away one. Go to page 1. Oh, who's this? Xin Yongfei. Are you here? Xin Yongfei. Okay. This is page 1. No, not yet. I thought they want to disable, no? They asked us to disable. Yeah, 99. Okay. Oh, Chong Yin Ying. Where are you? Malay hometown already, is it? 6,000 over kilometers away, or meters, I don't know. Ada? Absent, Absent. Oh, this is go to Singapore already. Here or not? Helena Jane. Out of range. Any more? Wow. Who is this? Lashman. Oh, these two together one. Oh, okay. Absent. That is a very bad misconception, you know. You see the person, you thought the other person is always around. This is not correct one. Okay? We always think so. You see A and B always together. You see A, you thought you saw B also. But actually, it may not be the case. Yeah. No more lah. Where? 7000 where? Oh, listening. Này, action. Này à? Okay. This is what we call random. Okay? We have no time to go and check everyone. Okay? So, because it's like this, very the slow. Okay? Don't play already. Go back to here already. We also like to play one, no. You don't think lecturer also serious one. We also like to play one. Okay? We play the different game than you. Okay, so this one, what do you do? Interest income, interest cost. So you're going to end up having a what? Net interest cost. How much is it? Take the difference between the two. Okay? Current service cost will come to the SOPL. Then what else? The other. Okay? Gain these two. One gain, one loss, which is larger. The loss figure is larger. The loss figure on the remeasurement loss. Okay? Or loss on remeasurement. This goes to the OCI component under the SOPL. SOP, you have to put in this figure. You have to put in this figure. So what do you have? So this is safe law, net defined benefit plan obligation. Okay? You have to show obligation 1250. Asset 1100. Then the net put in the SOFP. Same goes here. Obligation is larger than the asset. So net defined benefit plan obligation. Okay? Of the difference. So of course you have the answers over here. In the SOPL, your current service cost. Then your net interest. So in this case here, net interest cost, because the cost is larger. Okay, net interest cost. Because this is cost, if you want, you can just total it up. But if you're not sure whether you total or don't, no necessity for you to provide this figure. Just give as it is. In the OCI, just now we have one gain, one loss. So net, the loss is larger. So you're going to have this loss. Okay? If you want to, you can put a loss somewhere. Net defined benefit plan liability, this is at year end. But usually we are required to do comparative figures last year. Okay? How do you find what is the status last year? Of course, you are going to take the beginning of the year. So you still ended up having a net defined benefit plan obligation. So if you want, you can put down here. Okay? Any questions? Play also takes so long. Huh? Okay, other long-term benefits. So of course, we have already mentioned other long-term benefits that the employees may get is like sabbatical leave. Sabbatical leave usually is for, it's quite popular in the education, whereby you just go off for 6 months to a year or so on, and then you will still be paid by the current employer. Okay, long-term disability benefits, and then nothing much. Termination benefits, this one we also mentioned before. Termination benefits are those not because you don't want to stay. It's because of something that happened from the employer's part. Employer may be downsizing, closing down, so they have to let you go. They terminate you. So they are recognized as an expense and liability if they have not yet actually paid. Okay, so usually it is not because the employee wants to leave. Okay, so it's like voluntary separation scheme. This is a VSS. If payment is to be made within 12 months after the reporting date, is to be made. If the payment is to be made, that means 12 months after, that means it's longer than 12 months, you may need to discount those obligations. Okay. Never mind. We do the exercise next class. Okay, but the exercise, you do it. Is that okay? You do it. And then next week, I think I also put up one more class exercise at the Teams. That is body and glove or something like that. Fit body glove or something like that. You go and check it out. Okay? That one I also want you to do because that one is also a past year question. Okay? AQ1. So you do that one as well. So I see you next week.
I don't understand the comparative analysis.
Comparative analysis usually is like your pen, red pen.
What color you want?
Never mind, never mind. So always when we prepare SOFP, okay, you will put here current year, right?
Oh yeah,
Then last year.
correct.
These are what we call comparative. So that means for you to get this figure, you will take this current year 53600 net defined benefit plan liability. Okay, for the last year figure, you have to take the opening one. This and this. What is the comparison? Let's say it's A.
Okay.
So obligation larger than asset.
Yeah.
So you are going to put the figure A here. So
Oh, okay.
last year, this year.
Okay, understand. Thank you.
Okay.
Thank you.